The state of Wisconsin will be asking the federal government permission to run a state reinsurance program. This all started with an announcement in Governor Walker's State of the State address in late January, where he introduced the Healthcare Stability Plan. There were many elements to that plan. One of them was a reinsurance program that would be run by the state. The Wisconsin legislature moved quite quickly and voted to advance that reinsurance fund legislation at the end of February. After this quick pivot towards supporting the Affordable Care Act, the governor quickly signed that legislation, and now we're to the point where federal permission is needed to advance. Federal permission would come in the form of an innovation waiver, a Section 1332 innovation waiver, a waiver authority created by the Affordable Care Act for states to think of new ways to make sure they can stabilize the marketplace and bring more people to insurance. Now, if approved, Wisconsin would be asking for about $150 million of federal money. They would then offer the balance of the requested $200 million needed to run a program, so about $50 million from the state. Now, a little background here. Overall, reinsurance has been seen by both sides of the political aisle as a way that could work to stabilize the marketplace. In fact, it was actually written into the original Affordable Care Act language. As you can imagine, however, in the very contentious world of the U.S. Senate, there were many fights over ways to make the Affordable Care Act work. For reinsurance to work, there had to be an appropriation of money that was very contentious, and it was very difficult for that money to get appropriated. It was politically tagged as an insurance bailout, and money never fully made it into a federal reinsurance program. Now, reinsurance was seen at that time as something that was needed when you bring a large number of people to the marketplace for the first time. The Affordable Care Act's individual mandate said everybody has to have insurance or pay a penalty. When you mandate that everybody has insurance, you're bringing a lot of healthy people to the marketplace for the first time, but in getting rid of the pre-existing condition exclusion, you also would be bringing a lot of sick and expensive people to the marketplace for the first time. Now, with this influx of patients to the marketplace, you could see how some patient census of some insurance companies may be sicker and riskier and therefore more expensive than others. Some insurance plans might have a very healthy, low-risk census. Others might be burdened with a little bit more expensive and riskier census. Reinsurance was a way to stabilize those insurance companies with the riskier patient census. Of course, you need federal money to go in to compensate that insurer so they can therefore bring the premiums down for the insured in their group or their plan. Congress, as we said, fought the Affordable Care Act in its entirety and especially funding mechanisms for reinsurance, and so that cost never really got passed on to the insurance companies, and therefore premiums in certain areas did increase. After living with the Affordable Care Act for many years, there's the realization that maybe reinsurance was a good idea, and states are now proposing to run their own state reinsurance plan. You might recall in the latest spending bill passed by the federal government and signed by President Trump, there was no federal reinsurance money. Once again, still a contentious issue at the federal level, even though, like we said, it has bipartisan support, but it seems to be a carryover of the fight against the ACA more broadly. Let's look at an example where reinsurance has worked. The state of Minnesota has a reinsurance plan that is working. A new report suggests premiums will actually go down 15% over last year's premiums amount thanks to the state reinsurance program that's part of the Minnesota Exchange. Now, when Minnesota first started its reinsurance program a couple years ago, they put about $300 million into their plan. The legislature had to get back together and say, we actually have to add about $500 million more over the next 2 years to actually make this work. Reinsurance can be expensive, and states that have run their own state reinsurance program have seen this firsthand. They have to put a little bit more money in. When that works well, you can actually see those premiums drop. So what's going on in the state of Wisconsin? Well, Wisconsin has asked, and this is in the 1332 waiver, they will be asking the U.S. Treasury and Health and Human Services to waive a section of the Affordable Care Act for 5 years, starting in 2019. And this waiver will help them implement the Wisconsin Healthcare Stability Plan, which is their version of a state-based reinsurance program. They're using the acronym WIHSP for Wisconsin Health Care Stability Plan. Now, it'll be administered by the Commissioner of Insurance. They will be in charge of making sure that this plan works, that the money comes in, that the rates are kept up, that the actuarial values are calculating the premiums and payments to the insurance companies happen like they're supposed to. And this is all contingent upon federal approval. Now, the OCI is responsible for operating the program, and they would be responsible for setting what are called attachment points, reinsurance caps, and the co-insurance amount. And these are kind of the levels that say at what point is a claim or is an insurance company experiencing so much risk that they need a reinsurance payment from the state. It's not going to be for all claims, but at least in the first plan year for 2019, the attachment point is set at about $50,000. If there's patients in your plan that are that expensive, if the claims are over $50,000, that would be the attachment point at which you would get some reinsurance payments from the Commissioner of Insurance, from the state of Wisconsin, from this plan. Concerns. Are there consumer protections written into this waiver proposal? Right now, there is no requirement or even a suggestion that if an insurance company gets money from the state of Wisconsin, because they're experiencing very expensive claims, that they then pass that savings on to the consumer in the form of lower premiums. Now, the state of Wisconsin says they estimate that premiums will drop 10% after the first year of a reinsurance program, because there'll be money going in to compensate the insurers for the expensive claims, and therefore premiums will just naturally drop. But it's actually on the insurance company to drop those rates to make sure that they can pass that savings on to the consumer. And there's no link between reinsurance and dropping rates written into this rule. So that's the first concern, is there's no affirmative language that requires the savings get passed on to the consumers in the form of lower premiums. Another concern, funding mechanisms. Now, like we said, the plan would be about $200 million, less than what the state of Minnesota first spent and then realized that they needed to put $500 million more into it. So right away, is $200 million enough is the first question. But secondly, where is the money coming from? Now, they had written in that about $150 million is being requested from the federal government. And this is a budget neutral cost to the federal government, because the state of Wisconsin says if you lower premiums, then you therefore lower advanced premium tax credits being paid by the federal government. So the federal government wouldn't have to pay the advanced premium tax credits to insurance companies. Instead, they would pay the reinsurance to the insurance companies. So they're not spending any more money. It's just being called, the payments are just being called something different. So this is a budget neutral argument, and that's why they think it'll be successful with the federal government. But that's if the feds agree to pay this full amount, the $150 million, and then the state makes up the other $50 million. If you read the language closely, however, in the waiver, it does say, but if the feds don't do this, if they approve the plan but don't approve the funding, then the state of Wisconsin would be left holding the bag for the full $200 million, and the state would agree to pay that. So the way that we get that $200 million is a question mark. They're assuming the feds will pick up a share, but if they don't, then they say the state will pay it. And where would they pay it out of? General purpose revenue is the first source, but general purpose revenue coming from budget money left over from other programs, such as the Medicaid program. If there's money left over in the Medicaid program, revenues at the end of the year was not spent on Medicaid recipients, then that money would revert to the general purpose revenue, which then could be used on reinsurance. So you could see, or maybe argue, there might be a perverse incentive to deny services in the Medicaid program and grow that budget so that money is available to fund the wealthier individuals seeking reinsurance. Because reinsurance really goes to unsubsidized marketplace recipients. So that's people that have income over 400% of the federal poverty level that do not qualify for advanced premium tax credits in the marketplace. They're the ones that feel the biggest burden of premium increases. They have larger exposure with bigger bills. Insurance companies would be compensated by reinsurance for that population. So this plan of reinsurance with the Wisconsin Healthcare Stability Plan could be funded off the backs of denying Medicaid to low-income, sickest consumers in our state to give it to the over 400% of the federal poverty level consumers. A concern. It's not a straight line equation, but you could see how that could be possible, and something that's written into the waiver right now. Now, there's broad delegation to the Commissioner of Insurance in here as well, and that's probably the largest concern. The language that was written into Act 138, which is the law that Governor Walker signed that says reinsurance can be a thing if the feds approve it, says that there is broad delegation to the Commissioner of Insurance to pass whatever regulations or administrative rules they need to make this work. And they can call them emergency emergency rules, even if they don't fit the definition of what an emergency rule is, which means it's very easy to propose a regulation and implement it very quickly without any hoops and hurdles in the way, and just call it the way that things work in Wisconsin. That's broad delegation of authority that's taken away from our usual way of making rules, taking power away from the legislative process, giving it to one person, the Commissioner of Insurance, and telling them you have free reign to make whatever rules you need that you think would make this work. That's a broad delegation of authority that's been found dangerous and inappropriate in the past, and it's written right into this law. Finally, there's required recommendations in the rule as well. So this waiver, Act 138, as it's written, says that at the end of the calendar year 2018, the Commissioner of Insurance should issue a report. They must give a report to the governor on how high-risk pools and low-cost insurance options can benefit the people of Wisconsin. It's not saying after your first year of implementing a reinsurance plan, give us an assessment of how things are going, what would also help stabilize the marketplace. It says, give us a recommendation on high-risk pools and other low-cost insurance options. So the battle days of high-risk pools, without a whole lot of data, because if this is implemented, they're hoping to do it right around election time. Not a coincidence, something we'll mention again in a little bit. But with only a couple months of data, they want a solid recommendation that high-risk pools will work in this state, which means instead of following through with all the requirements of reinsurance, maybe we should just pool our sick people into one pool and charge them higher premiums like we used to do before the Affordable Care Act was a thing. It's a bad thing to have written into this law that recommendation has to come from the Commissioner of Insurance at the end of the calendar year. Also, it's projecting a little bit because that recommendation, not an assessment again, a recommendation also has to include low-cost insurance options that the state should adopt. And right now that conversation is short-term insurance and association health plans. The language coming out of the federal government as ways to give states flexibility and sidestepping requirements of the Affordable Care Act. And this law, Act 138, writes in that the Commissioner of Insurance has to recommend that these are good ideas. There are a couple other concerns. We don't have time to go into all of them. But here are a couple more. The Act specifically includes language that prohibits the state of Wisconsin taking Medicaid expansion money. Not at all relevant to the conversation of reinsurance. You know, states that have reinsurance, like Minnesota, also have Medicaid expansion, so they have additional hundreds of millions of dollars coming into the state to help facilitate the Medicaid program and reinsurance. Wisconsin's legislature, when they drafted this, and this was a very contentious point in front of the Joint Finance Committee when the Senate bill came before Joint Finance, before it got passed on to the governor for his signature, Medicaid expansion was very hotly debated. The Democrats in the room insisted that Medicaid expansion be part of the conversation. The Republicans said it's not allowed that we even talk about Medicaid expansion. They carried that prohibition on talking about Medicaid expansion right into the language of the law that says you cannot take Medicaid expansion unless there's a legislative action to do so, and that has to come separately. So a funny thing to include, but they wrote it right into this law on reinsurance. Other concerns, it is expected that enrollees who stay in the marketplace post-reinsurance will be healthier and younger, so they're already projecting of what the population in the marketplace might look like than those if there's no waiver, which means that the sicker and the more expensive people would not be in the marketplace post-waiver. So there's a little bit of more we need to read on what the census looks like after a reinsurance program is instituted. And finally, we're wondering if this is much ado about nothing. So we have a lot of concerns here, and the language of this reinsurance bill seems very dramatic, but they think they can reduce premiums by 10% and bring 0.8% of people to the marketplace as new enrollees. So we're not talking about bringing a whole lot of new people to the marketplace through this and only saving about 10% in premiums, which let's look at in terms of the broader conversation right now about costs in the marketplace. So all of this to do is about stabilizing the marketplace and bringing premiums down, but their total premium savings amount they project to be 10%, which comes on the heels of a conversation that short-term insurance, association health plans, and the GOP tax bill could raise premiums in the state of Wisconsin by 90%, whether or not there is reinsurance. So if we think that premiums, because of all of these other provisions that are working their way through the federal government right now and being instituted in states with proposals for association health plans and other ways of bringing in short-term insurance in the state, if that actually happens, and the Kaiser Family Foundation tells us if that happens, that's going to spike premiums in your state, then is it really a big deal at all if reinsurance helps bring premiums down a little bit if they're going to go up by a larger percentage anyway? So the consideration that's not happening here is looking at the insurance premium rate in totality after all of the changes being proposed right now at the state and federal level actually have their impact. And I would argue that a 10% premium savings means practically nothing if your insurance premiums are going up to over the next 3 years of almost 90% because of all of the other rules that you've passed that have a negative impact on marketplace stability. So it appears to further diminish the impact of reinsurance. There's a lot to read. The draft waiver right now is about 14 pages. You can get through it pretty quickly. The paperwork that the Commission of Insurance makes available also includes an actuarial report, and it also includes the Senate bill language and Act 138. So in totality, you're looking at about 50 pages you might have to sift through. The first 14 pages are the most important, also the most filled with political language. So you have to sift through some of that to actually get to the point of what's being proposed. You have the ability to read this and comment on it in the state of Wisconsin first before it gets submitted to the federal government for review. Your comments matter because the state is mandated to take public comment into effect when they make their final draft of the language that's then going to go to the federal government. Once the federal government receives the draft 1332 waiver, they will have their own public comment period. So you actually have 2 chances to comment on this. Read the draft, see what you like, what you don't like. Like we said, this is not all bad. Reinsurance has worked in other states, like the state of Minnesota. See how this is distinct from that and where it could be improved, and make your constructive criticism in your public comment. You can do it by email. You can write a paper letter. You have only a short period of time. You only have until April 14th to do this. So within the next 2 weeks or so, you should get your public comments together and get them off to the Commissioner of Insurance. They have to look at your comments. They have to consider them when they put their final waiver proposals together to go to the feds. The feds then have time to review this. And like we said, the state is hoping to get word back from the feds before the November election for governor in the state of Wisconsin, which could be, of all of this, the number one reason why it's being proposed right now. This is an election year. This would be a really great talking point in a campaign for re-election to say, and I helped stabilize the marketplace, I got a reinsurance plan together. You would then have to review for yourself and see if you think that impact is de minimis, as I think it might be. You can read that waiver on OCI's website. You can read Act 138 itself, the law of Wisconsin right now, should the federal waiver be approved. And you can do all of that online. You can send us a question, a comment, share your feedback with us. If you get stuck trying to submit public comment and you have some process questions, give us a call. We can help facilitate, make sure that you can have your voice heard on this very important topic. You can do all of that at healthwatchwisconsin.org. Thanks for joining us.